And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
And it's about 22 to 5. Luke Smith from Envision Financial. Good afternoon.
Good afternoon.
I tell you what, it's not a bad-looking day, although it is a bit breezy.
Look, you know what? If you got rid of the wind, it would be absolutely glorious.
Yeah, but playing golf in the weather like this, don't know where the ball's going to go.
Well, you can have the best of intentions in weathers like this, but intention and ability are two very different things.
Oh, that's right, exactly.
Exactly.
Now, we've been talking lately about all sorts of things in relation to getting your money into super. And, of course, one of the things that we've considered before is salary sacrifice.
Yes.
And, of course, the idea being to make a contribution and claim a tax deduction when you do so. But the question today that we're going to attempt to address is a salary sacrifice the only way to get money into super and claim a deduction?
Yeah, look, and this one, I guess I've made today's show off the back of a series of queries this week in meetings, and the surprise on people's face when I tell them that salary sacrifice is old school and not something that you have to do, because everybody says, well, I do this much because that's what I have to do. And I said, you can put your own money in, right? And they go, no. Can I what? My work gets it wrong and they charge me, and people have a myriad of issues with it. So today's really just about clarifying that you can use your own money from any source and make a contribution to super and claim a tax deduction and get exactly the same tax outcome as if you'd gone to your employer and said, hey, could you put $200 a fortnight into my super, please, for the rest of the financial year? So this show today is really about awareness and understanding how you do it, and just, I guess, reconfirming, which we will, the rules and regs. But we'll go through how you can do it, the mechanics of doing it, and the paperwork that's involved in doing it, so that if you don't want a salary sacrifice and increase your pay, because you might want to pay your home loan off faster, great. You then have the ability to get to June, call up your super fund and say, hey, super fund, what's come in? And they might say $15,000, because obviously work is making a superannuation guarantee for you under the law. Whatever your number is, let's use 15 as an example. We know the annual limit is 30,000. I've got 15 in from my work. That means I could put in $15,000 in June and claim 100% of that money. So I want people to be aware that they can, because the big thing about this is too often people come in later in the year and want to start salary sacrifice for whatever reason, but can't get enough in because of their remuneration and the time frame left at the end of the financial year. So what we're going to explain today, a personal concessional contribution, is a great way to do that, because you might want to, say, pay something off, pay some school fees, whatever it is. You might want more of your pay. You might stop your salary sacrifice and just add the money in June.
Now, tell me if I've got this wrong, but if I take the salary sacrifice approach, I go to my employer and ask for the employer to take away some of my salary pre-tax and put that into the super fund.
Yep.
And what happens then, of course, is that the salary I am paid is lower, and therefore I'm paying less tax on that salary, and I get the tax benefit right then and there every fortnight.
Correct.
Or whatever the period is for my pay packet.
Yep.
If I go the other way, if I go, let's put a direct contribution into the super fund and then claim a tax deduction, I'll get exactly the same outcome, except I have to wait to the end of the financial year to get the tax back.
Exactly right, because you may want additional money in your pay to pay your mortgage off faster, to pay for A, B or C, to invest money or whatever it may be you're going to use the money for. But you're exactly right. Your employer takes the pay, reduces it, makes a super contribution. Great. You then have the ability, if you want, to not salary sacrifice, get to the end of the year, put in the same $15,000 that you could have salary sacrificed over 12 months, claim 100% of that as a tax deduction, and all that happens at the end of the year is your tax agent says, you earn $120,000, you put in 15, your taxable income is now 105, your work has taxed you on 120 all year, not knowing what you've done, and you get a refund.
Yeah.
So it's just about understanding the best way that works for you. It's not about saying, is this one better, is this one worse? You get exactly the same tax outcome. But I like the personal contribution option myself because I find a lot of people want control of their cash flow.
Yeah.
And if you have a mortgage on your house, you can fill up your offset account all year, and then you could go to said offset account, pull the money out, and then make a deductible contribution, get a refund back in the offset account. So in theory, you've had two uses for the same cash in a way.
Yeah, absolutely, because while it's in the offset account, it's providing that benefit of dropping your interest bill.
Exactly.
And then at the end of the year, when you take it out of there, put it into the super fund, you've got that other tax deduction.
Exactly.
Yeah.
Exactly. So again, it's not about, is this one better, is this one worse? We'll have comments on YouTube, oh, you said... We're not saying anything. We're just making people aware of your ability to do it. Because let's say you salary sacrifice a little bit. Let's say you had $15,000 of space in your cap and you salary sacrificed 10. Mm-hmm. Well, guess what? You can put 5 in yourself.
Yes.
So it's not about is it this or is it that. You can do both. You can do whatever suits you. And that's what I want people to do. But more importantly, I want people to know that they can. Because people get really frustrated when they go, oh, but if I do it through my work, they charge me. I don't want to do it. Okay, they shouldn't be doing that. Like when you can put the money in yourself, do it yourself. Don't be charged because nobody's adding that much value to your position that they should charge you for salary sacrifice.
No, and of course, you've already made the point that if you continue to take your full salary and then make a contribution at the end of the financial year, that means you've got the money in your hands to do whatever you need to do with it, whether it's put it in the offset account or reduce your mortgage or whatever the case might be. The flip side of that coin would be, I guess, what about somebody that feels, I don't have the discipline to stop myself from
100%.
Spending that money on wasteful things. Salary sacrifice is what I want to do so that I don't have that temptation to deal with.
100%. If you have a shoe fetish and you just cannot help yourself and you're a financial lunatic, then salary sacrifice is right for you. Again, it's not about this one instead of that one. It's just about finding a methodology that works for you. If you're a lunatic, get it done at the employer level because out of sight, out of mind is wonderful. And if you get to the end of the year and you find, well, I've got a little bit of space, I'll put some money in at the end myself. Great. You've used both methods. You've got a great outcome. You've lowered your tax. You've bolstered your super. Hopefully the tax you pay putting it into super is less than your marginal tax rate. And it's a great outcome all around.
Yeah. Now, when you do put your own money in, there are a few things you need to remember, aren't there?
That's right. So when it comes to making a personal contribution, you are now responsible for notifying the fund of your intention to claim the deduction. So if you were coming into the end of the financial year, and this applies any time, but I generally say if you wrap it up in June, you know exactly what's come in from your employer. So on the 1st of June, you might ring your super fund and say, hey, super fund, what's come in? 14,000. And what comes in June? You get about 1,000 a month. Okay, so I'll have 15,000 of my $30,000 cap. I can put $15,000 into my fund. So you would call up your fund and say, I'd like to make a contribution. How would you like me to do it? You'll get a BPay information. You'll get EFT information, however your fund deals with it. On the 2nd of June, for example, you put in your $15,000. Now, this is where it's important. On the 3rd of June, and I generally say do the paperwork when you do the contribution, so then you don't forget. So you must lodge what's called a notice of intent. ATO regulated form, quick Google, 100 links will turn up. It's a standard form that gets sent to the fund. Front page says, this is my information and my super fund. Second page says, in what year did you make the contribution? 2026. How much did you put in? $15,000. How much of that would you like to claim as a deduction? Generally, same number, $15,000. You sign it, you send it into your fund where the money went. Don't send it to another fund, okay, and then ring me and say I didn't get a deduction, because that has happened in the past. And somehow that was my fault. So money in, next day, form in, and then the fund will write back to you and say, hey, Leon, thanks for that form. We will treat that as a deductible contribution. Keep that communication, because your accountant is going to want that as proof that it's been treated correctly with the fund that you use. And I often say to people, give your accountant a copy of the notice of intent as well, because there's some written proof of what you've done. Then your accountant will work their accounting magic, and all of a sudden your taxable income has fallen $15,000. And if you're earning 120 grand and paying an average of 30% tax, and you've paid 15% tax putting it into super, happy days. So that's the mechanics of how you do it. And as I said before, you can salary sacrifice and do that. Now, just to clarify for the question that will come, do I need to fill out the form for the money that is done through my work? No. Your work will declare that. Your work will lodge that. Your work will take care of whatever is salary sacrificed. You're only putting on the form the personal money that you have put into the fund that you wish to claim a tax deduction for. Because you may, for example, have $15,000 of room, but then have another $20,000 of space where you use the catch-up legislation. Looking back 5 years, you might put $40,000 in. So then you put the notice of intent in, 40,000 went in, I'm claiming 40,000, sign it, send it to the fund, get your notification back, keep it, give it to your accountant. Happy days, you get a refund back in the offset account, and around the mulberry bush we go.
Luke Smith from Envision Financial is with me in the studio today. We're asking, is salary sacrifice the only way to get money into super and claim a tax deduction? Clearly the answer is no. So the time has come to ask, what are the key things for people to remember?
Yeah, so make the contribution that's right for you. If doing salary sacrifice works because you're a lunatic and you don't trust yourself, do it. If using the money for something else and you have some discipline and can save and have access to capital from an offset account, the sale of an asset, or wherever else it comes from, then think about making a personal deductible contribution at the end of the year. Remember that you can do both. You can have some salary sacrifice and a personal contribution. Just don't go over the relevant limit that is applicable to you. If you're making a deductible contribution, it's $30,000 for everyone. It's also $30,000 no matter how many jobs you have. Because I was told by somebody this week that it's $90,000 for them because they have 3 jobs. I was like, okay, good luck with that. Make sure that if you do make a personal contribution, you lodge the notice of intent in a timely manner. If you make multiple contributions, just do one form at the end. You don't need to do a form every time. You can, but then you'll be constantly amending your paperwork. So put in whatever you're going to put in, then send in one form at the end, taking into account all of the contributions that you've made. Give the notice of intent and the communication that comes back from the fund to your accountant. They will need it and want it, because at some point, if there's a knock on the door from the ATO, you need to be able to produce the confirmation from the fund to be eligible for your deduction, as far as I'm aware. Get your money into superannuation well in advance of 30 June. We've had a few financial years where it's been on a weekend or very close to. So I generally say action that stuff at the start of June, then you know you're nice and early. Whether it's salary sacrifice or personal deductible contribution, salary sacrifice is pre-tax, personal contribution is post-tax. It doesn't matter. It's the exact same tax outcome. One is not better than the other. It's just 2 different ways of doing exactly the same thing. So just use the one that's right for you. And if you're looking to maximise your contributions to lower capital gains tax, or you've inherited or sold an asset, also then consider the 5-year look back, the concessional catch-up legislation, to bolster your contributions where your super is under $500,000. Same process applies. Amount goes in, form goes in, fund rights to you, information goes to accountant, smile on face, get refund, use refund, buy some shoes, put it in the offset, whatever floats your boat. But just do it the way that suits you best. And remember that salary sacrifice is old school and is just one way of getting a deductible contribution into super.
Yeah, and on that basis, there's nothing wrong with it. And for some people, it's the more suitable way to go.
Correct. It's not about, is this one better than that one? 6, 2 3s, same thing.
Yeah. So it's whatever suits your particular needs best.
100%.
Okay. So, Luke, where can listeners get more information?
So, office number 6260-4749. We've got envisionfinancial.com.au on the internet. That's Envision with an E. We've got the podcast, the Strategy Stacker Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got the back catalogue of all the shows. And we've also got an entire chapter in Smart Money Strategy, your ultimate guide to financial planning, in all good bookstores and online.
And don't forget, of course, we're almost at the end of September, and you know what that means. Christmas is looming large.
Christmas is looming large. That's it. Get into Demics and sort it out.
Well, as you said, all good bookstores. I told you the other day I saw your book in a display of all local Canberra authors, you see. So there you go. You're being actively promoted.
I was sent a photo from Manhattan.
Wow.
It was in a bookstore in America in a summer. I had a client on holidays, and so very surprising.
Indeed. Luke Smith back again at the same time next Friday afternoon on 2CC.